Thank you everybody for joining and taking the time today for our webinar on the topic ESG and Sustainable Investing and why it matters. We're going to discuss a number of interesting topics today, and I'm very happy that we have three top experts on this in the field as guests here, and thanks very much for agreeing to join us here. We will be talking about ESG, so environmental, social responsibility and governance investing, and of course also impact investing in general, and why is it important in today's world and is also attracting so much of assets. In the end, we will leave some time for the Q&A session for all of you. We have outlined also the broad flow of that. So we have first basic understanding of ESG and sustainability. Then, thanks to the attendance of professionals in the sector, we're going to talk about investment processes, the styles of investing. We want to look at the performance of ESG and sustainability themed investments, and also look at potential investment opportunities in the market. Lastly, if we still have time, we want to talk a little bit about regulations, governance surrounding the theme, and kind of like the broader frameworks here. And of course, very important to leave a couple of minutes of time for a Q&A session at the end of it. As with all webinars, a quick disclaimer before we start. Please note that all information and discussions that we have here is only for general reference. This is not investment advice. Please contact your licensed advisor should you seek any further insights here. And yeah, with that in mind, please bear this in mind. Let me get to the introduction of our panelists today. We have here from as the head of international developed markets equity for Goldman Sachs asset management, Alexis Deladerrière. He is overseeing portfolio management and investment research for the firm's global and international equity strategies. And he's the lead portfolio manager for the GSAM Global Equity Partners and Equity Partners ESG Fund. Alexis earned a master's in finance and economics and general management from, I just go with the acronym ECCP in Paris in 2003, and is a CFA since 2006. Alexis, thank you so much for joining and taking out the time of a busy schedule.
Thank you for having me.
And we have James Norman. He's a managing director with GSAM and focused on working with clients on ESG and equity strategy. James is a managing director and is focused on working with clients on environmental, social, and governance and equity strategy. I understand correctly, James, that you are working on implementing customized solution for your clients. You're leveraging there on the full suite of the ESG and equity capabilities of GSAM, and you've joined Goldman Sachs as managing director in 2019. So James earned a bachelor in economics from the Vassar College and an MBA in finance and management from the university with distinction. So congratulations to that, James, and thank you very much for joining us and taking the time.
Pleasure to be here.
And then, of course, last but not least, Victoria Leggett. She's the head of impact investment and the head of responsible investment for asset management at UBP. Victoria joined UBP in 2010 as a portfolio manager and has 17 years of experience. In addition to your role as head of impact investment, she also manages or co-manages UBP's flagship impact fund, the UBAM. Welcome, Victoria. Thank you so much for joining. Really excited to have you here.
Thanks, Thomas. Hi, everyone.
And last but not least, myself, my name is Thomas Meichel, and I will be your host of the session today. I'm heading the trading and asset management at Kristal.ai. Prior to joining Kristal, I've been working in JP Morgan and in various other portfolio manager and trading functions across hedge funds and banks in the past. So really excited to be here and to have that great round with our panelists. Before we get started with the discussion, I wanted to launch a quick poll for our attendance and for our guests here. So our question is that we would like to know before we get started, just to get a little bit of an understanding, what is the percentage of ESG theme-related investments in your portfolio at the moment? We have 4 choices. We have 0 to 15%, 16 to 25, 26 to 50, or more than 50%. We've got a good participation. So you see, it's actually a relatively small percentage point. That's quite surprising. I expected slightly more. Share the results. So we have 81% in a 0 to 15% bucket and 0% in more than 50%. So as we can see, there's still a lot of growth here from our audience. Thanks very much for your responses on this. Yeah, so we want to discuss a number of interesting topics today. And I think one of the things is that we have seen enormous growth in this entire investment theme of environmental and social governance investment. And it has been coined as a term about 15 years ago. Some people claim that it has been around for much longer, but we've really seen consistent high growth rates in that sector. It has become the headline word in many ways, and we wanted to take the opportunity today to demystify this a little bit, to share a little bit of a perspective. What does ESG mean? What does sustainable investing? Currently, globally, around 3 trillion under management invested in funds that are with the main focus of ESG. And according to Morningstar statistics, alone in the first quarter of 2021, we have seen inflows of in excess of $185 billion US, and we are still growing at a rate of about 20% per quarter here. So as we want to discuss this, maybe I start off with James, and I'm looking for your insight here. So we have often a little bit of confusion around the different definitions within ESG, and it's a whole alphabet soup that we have here about different themes. So can you help us to understand and define a little bit more what is ESG and what are the different subgroups here, and how has it evolved over the past few years?
Great, thanks, Thomas. Absolutely, I'd be happy to do that. And it really has been an alphabet soup, and I think that's led to a little confusion. And it's also combining that with really an evolution of how people think of these types of characteristics or factors. I think if you look back a longer time period, really what people defined as what we now call ESG really started out quite often as being themed as sustainable in socially responsible investing, or SRI. That was a common term. And there was a little bit of a flavor that to do good, you couldn't necessarily do as well, that it was concessionary, that you were giving up something to do something positive for the environment or for workers, or in terms of how you govern, and what the focus is purely on shareholder value growth. But really, I think that has evolved quite dramatically over the last 5 to 10 years. And the what now people call ESG and sustainable investing, what that is really is quite different than how people thought of it, let's say 5 to 10 to 15 years ago. And really, I would say in sum now, what we mean, and what most people who are in this area and investors are sort of think of this space, is that really ESG, or environmental, social, and governance factors, lead to a more sustainable company performance. And it really, these are factors or characteristics that are great complements to traditional financial metrics, looking at, for example, what is the revenue growth, what is the earnings growth, how is the company managed from a strategy perspective, things of that nature. So more traditional financial metrics. And really that there's increasingly they're being seen as key drivers of business performance. So It's really grounded more in an investment thesis that by focusing on these particular issues, the company will outperform and have more sustainable performance over time. And just to dig into that a little bit further. So what does that mean? Because that sort of sounds, it's a little vague and amorphous. So to make it a little more concrete, if we look at things like environmental factors, it's things such as how does the company manage energy? A lot of companies require a lot of energy to produce their goods. But what do they do in terms of greenhouse gas emissions across different sectors? That's very important. And increasingly, as investors, governments, corporations, and consumers are focusing on these issues, they want to know, is the particular company emitting a lot of greenhouse gases that was going to lead to really negative climate change? And from an economic standpoint, will there be carbon taxes, which increasingly are going to be a tool used by policymakers that will actually make it more expensive for that company to operate because of how they manage their emissions? In terms of the social things, what are the labor practices? Does a company treat employees well? Certainly the global pandemic really brought that into bear in a much larger way, and it was very public in the press. Did companies treat their employees well or not? And that really affected their ability to attract and retain the best employees, which we all know as companies are growing is critical to success. But not only the labor practices of their own, but also how about their supply chain? Who are they sourcing items from? And what are the practices of those particular companies? Because consumer brand is certainly the easiest to understand. If they're, for example, buying cloth from a company that employs child labor or has some type treats its workers poorly, consumers really will shy away from those companies. And with sort of the increasing ability to see these things through media and social media, et cetera, that really is much more visible and important in terms of company success. And then lastly, on the governance side, is there independence in the board? Or is there really a lot of the control in a small group of management that can make decisions that might be in their interest, but not so much in the interest of the other stakeholders and equity holders or bond holders in particular, by doing poor acquisitions just to empire build rather than being thoughtful around these decisions. And then also diversity, which increasingly has become a focus, is, and I think a really sort of concrete example, if a company is focused on where women are the decision makers in buying the product, or it's focused on selling to women, if you don't have a diverse board and a diverse management team and executives at the company, you're really missing out on the opportunity to understand what drives the buying behavior of that market if you don't sort of can't relate in the same way as someone who's actually of that group. So those are some examples, and really the thesis is by focusing on these characteristics and understanding how they are employed at a company, how they affect a company, it's going to lead to stronger growth, higher productivity, and lower cost of capital. When you're issuing debt and equity, can you do so at a premium so that you're able to lower the cost of capital growing that company? And that at the end of the day, when you do all these things well, you're going to have this positive cycle of being able to attract and retain not only the best employees to increase productivity and so on, but also clients over the long term. And you're going to be able to grow that business faster than your competitors who aren't as good at these things, or where they might have risks and sort of bad practices that lead them to really be handicapped. And just in summary, I think this is really around, one way to think about it is that rather than a credit score that you do for fixed income, it's a sort of a sustainability credit score. Is that company really seen as being a leader and being effective at dealing with all these factors to really maximize their growth over time? And I think that's why people are so focused on it. As intangibles have become a larger part of the sort of valuation of a company, it's not only looking at the financial, you have to look at these other things that really affect brand and trust, and these other things that are the intangibles that increasingly are becoming a larger part of company value.
That's great. Thanks very much for that insight. I mean, brings me to a little bit of a follow-on question. So the way how you described it, it almost seems that the ESG is actually then a little bit misunderstood, because it falls under this umbrella of like, oh yeah, this is about environmental risks. But is it correct to say that you are looking at it more, and maybe that's a question more for Alexis, in your day-to-day work as a portfolio manager, do you look at these ESG factors then more as as risk factors for the performance of a company that you are then looking to apply, like for example, quantifying risk from carbon tax, quantifying risks from conduct, for example, from the social responsibility and governance as well. Are you looking at it from that perspective, or is there something else that you do in your day-to-day perspective as a fund manager?
Yeah, thank you, Thomas, and good afternoon, good evening, everyone. Yes, and you're right first that we've seen huge adoption of ESG or sustainable investing, and it can be indeed a bit confusing. And there is no meeting with our clients that we're having now that doesn't include a discussion about ESG. And then in return, in addition to that, there is no meeting with companies that we invest in that doesn't include discussions about ESG. So it is certainly becoming more mainstream and becoming a number one, I would say, topic of discussion among clients and among investee companies. Ultimately, just taking a step back, I think it's not that complicated. It's effectively taking a holistic view to invest for the long term. It's really trying to think more broadly, not only about financial return or the purely the financials of a company, but just thinking about the company's place in the world and how they are behaving, what sort of practices they are using and adopting, and how they treat all their stakeholders, whether it's their employees, their clients, or their suppliers, and ultimately the environment. So it's really taking a long-term view. I think you can't invest for the next 5 to 10 years as we do if you don't take ESG factors into account. They are part of every analysis that we do on companies to try and really understand the risks and opportunities that may come from that. And really to simplify, if you want, we look at it through 3 lenses. And the first one is about values, and the second one is about performance, and the third one is about externalities. About values is to try effectively to align our portfolios with our clients' values, and make sure that our clients' portfolio reflect our clients' values. And so really trying to avoid investing in any companies that our clients would not feel comfortable with in their portfolios. And they probably don't want to buy products from these companies, and they don't want to have these companies in their portfolios. So the first step is about, to a large extent, negative screening, whether it's systematic, whether it's fundamental, but it's really about avoiding certain types of companies and activities and aligning portfolios with our clients' values. The second step is about performance, and that's really the core of your question. And for us, we believe that over the long term, taking ESG criteria, ESG factors into account can help us optimize the risk-adjusted return. And it is really over risk and return, and trying to think, what are the risks that are embedded in a company, in a business model, in their practices, and does it create additional risk that over the long term may bite them and may reduce the value of the business, which as an investor we want to know about, because they may be low probability risk, but they may be high impact risk. And so we want to certainly avoid companies that may have, again, practices and activities that could be at risk to the world, but ultimately to the value of the business. And then on the other, at the other end of the spectrum, it's about opportunities, and really there's a lot of changes happening in the world, and that's really truly what we believe is a sustainability revolution, which started with climate, and that's certainly top of mind, but we believe is going to broaden to more social factors as well. And we can expand on that, we can talk about that. And it creates a lot of opportunities for companies. If you think about clean energy in particular, the whole climate transition, and all the opportunities that it can create, and really, again, taking a long-term view and trying to position our portfolios for this transition and for the best practices and the best opportunities that could come from that. So it's about risk, but it's also about opportunities. So yes, mitigating risk, understanding risk is an important factor, but an even more important one for us is actually tilting our portfolios toward these opportunities and companies with better products, better practices that can benefit from that. And then finally, the third aspect is about externalities, because we believe that as fiduciaries, we can really impact the activities and the practices of the companies that we invest in. And we engage very actively with all the companies that we invest in. We have a regular dialogue with them, and we raise issues that we, there's no one company that does everything well. And so there are always practices to improve. And even in the ones we have in our portfolios, there are things that we wish they could improve. And so we engage with them on these topics to try and help them improve their practices, help them understand what potential risks and issues are, and help them on that journey to become ultimately better companies that can create more values for all stakeholders, but in particular for shareholders.
Great. Thanks so much for that perspective, Alexis. There's a couple of things that you mentioned with regards to performance and opportunities, etc. I would like to put a pin on that and return to this later on. There was one other thing that you mentioned that has kind of like brings me to Victoria and a question for you. It's about affecting change, working with the companies, and you are the head of impact investing at UBP, which is a European institution, and ESG investments in Europe is particularly strong. So that the fund flows that I mentioned in the introduction, around close to 80% of those fund flows are coming from Europe. So I think you are in a very good position. You probably see a lot of that in your day-to-day work. So Victoria, my question for you is actually twofold. First of all is, how do you see, or how would you define the difference between ESG investing and impact investing? And the second question then would be, how do you affect change with the companies that you are investing in?
Thanks, Thomas. Yeah, it's interesting to sit in the center of a European organization, particularly at the moment with so much regulation change going on in Europe, and it really does seem to be at the forefront of that. And there's a lot of interest from European clients around this topic. The distinction between ESG and impact, I think going back to James's alphabet soup point, which is a very good one, we can get very easily bogged down in jargon in this particular sector. And I think it's important to emphasize that semantics aren't important here. It's the direction that capital is flowing into that matters. But I guess to pick up on a point that Alexi made, I guess impact is probably focused more on the opportunity side of the whole debate, in the sense that ESG, in our view at UBP, is an absolutely critical element of assessing any company, any portfolio in any asset class, for all the reasons James very eloquently described. But what ESG doesn't do necessarily is define what a company sells. It's really about how a company behaves. And so impact takes a real focus on the product streams of those businesses, what they're selling. I mean, an extreme example, I guess, would be you could have a very high scoring from an ESG perspective. You can have a very high scoring tobacco company that has an excellent board structure, that has really good growing practices in its field, that it has very, very transparent supply chain. Nevertheless, its end product is arguably not generating a positive impact. So I think that distinction is important to highlight, although I don't think it's additive to get too bogged down in the semantics. But in terms of affecting change, really when my area is more in listed equity, I think the critical part of that is engagement. To echo some of what Alexi mentioned, being active and interested and long-term supporters of capital, providers of capital. And coming at this with that attitude is really critical, so that the interaction with the companies with which we invest is collaborative in nature and helping them shift along the sustainability curve, rather than simply I think engagement can sometimes take the form of questionnaires or take a more castigating approach, and that rarely delivers great results. Whereas actually forming relationships with companies that have the intentionality to move along the curve and supporting them in that can be an area where, particularly in listed markets, there can be some real additionality created.
Great, thank you. I can imagine it's probably very rewarding when you have the investment performance, and then on top of that also the KPIs in form of like something has been changed and you have been able to affect something at a company level. That must be a very rewarding thing. Thanks for that perspective, Victoria. Before I go into the next topic, I wanted to raise another poll for our attendees. So the question is, what do you think may be the best instruments to access ESG related investing? We have here choice between active thematic funds or ETFs, passive ETFs, stocks, bonds, or private markets like private equity or venture capital funds. So I'm quickly launching that poll. And while we're waiting for some results to come in here, I want to move on a little bit to the next part of our discussion here is to get a little bit of a better understanding on the practitioner's viewpoint when it comes to ESG and impact investing. So we have been talking about, and we have heard from Alexis, that there is significant research that claims that ESG may provide better returns for investors and companies alike. But has it actually been so historically? So maybe, James, maybe you have some since you have the broader picture of the sector, maybe you can share some perspective on this.
Yeah, Thomas, that's a great question, because it's nice to talk in sort of investment thesis space, but what was the actual impact of people focusing on these issues? I'm very pleased to say, especially with more and more data on this, that it does seem that in the various investment funds and strategies that focus on incorporating ESG and are sort of, rather than a lighter green, oh yeah, I think about this, or more, the ones that are more darker green that truly do identify, I am an ESG oriented fund, that is a major part of my investment objective and process, that those companies have done better. And let's put some numbers around that. If you look back using the Morningstar data that you talked about earlier to look at what are the funds that are tagged as ESG, where it's the key core part of their investment objective, how have they done over the last, let's say, 1, 3, 5 years? We did some analysis looking at Morningstar data, looking back over those time periods, and what we consistently have found over both the 1 year, the 3 year, and the 5 year is that funds that are self-identified as ESG and vetted by Morningstar as being ESG, so in that ESG category, were much more likely to be in the top quartile and much less likely to be in the bottom quartile. And so let's say in that bottom quartile, it generally ranged from 10 to 12% of funds that are rather than the 25 you would expect, sort of in those relevant peer groups. And in terms of the top quartile, it was more in the mid to upper 30s in terms of a percentage of companies that were our funds that were actually in that particular quartile. So better chance of outperforming, less chance of underperforming. And one of the things we also looked at too, because one could think, oh, well, maybe it's because they avoided some challenging sectors, like energy, as we all know, has been a challenging sector for performance, certainly for quite a while until recently there's been some bounce back. But even considering that, when we take that into account and look at those funds that outperformed, it was that outperformance versus peers coming from sector allocation or stock selection. And we did an attribution analysis to determine that. And what we found was that 72% of the excess return came from stock selection, not from sector allocation. So by sort of maybe underweighting some of those more challenging sectors that you would expect, that helped a little bit, but the vast bulk of it came from security selection, because it's really considering these other factors that increasingly investors are feeling are important. The market is feeling important. That's where the revenues are, and the revenue growth, companies that are better stewards of capital. So at least the results, really have been highlighting that, and that's why I think you've seen those fund flows as well. If you look at active management, just as a great example, active management in the equity space has been very challenged. It's lost, a fair amount of assets over the last 5 years. Too passive, certainly. But what's been an interesting, really something that's bucked the trend has been ESG tagged funds. They have actually grown substantially. So I think investors are voting with, I'm either going to do something passive or I'm going to do something that's active that takes into account these key material factors that are not so apparent in traditional financial metrics, because they're going to be a key driver of success, and they have been.
Yeah, great, thanks. For me, it always begs the question that a lot of if I look back at the performance over the last 10 years, a lot of the performance has been driven by technology, and broadly speaking, that technology has outperformed the old industry parts of it. And I would assume that technology is greener or better, and also scoring higher in terms of social responsibility, etc., than some of the old industries. Do you have any evidence in the data that if you strip that out, if you have a like-to-like comparison, if a company does good and another company in the same sector is not as good, do you see hard evidence there in terms of revenue growth or cost of capital that there is a difference? Maybe Alexis, you have gotten some data from that front.
Yeah, thank you, Thomas. And you raise a good point around technology and effectively style biases in ESG portfolios, because you're right. If you look at the market in a very binary way and thinking about growth stocks on one side and more value stocks on the other, by definition, value stocks will tend to be more challenged companies that are operating in markets that may not be as fast growing and as the growth part of the market. And in particular, you will find companies that tend to be asset heavy. So you think about utilities or infrastructure or energy companies. These are all companies that would be in the value part of the market. And by definition, if you own your assets, if you are asset heavy and own your assets, you're more likely to have issues in your own operations and have assets that may be polluting things. So again, think about energy, utilities, some infrastructure names. By definition, they are assets that have been standing there for a long time and maybe designed 20, 30, 50 years ago, even longer than that, without necessarily the same pollution criteria or technologies that we would use today. And so by definition, these are companies that may be scoring less well on ESG, may have practices and may have activities that may not be seen as in a positive light when looking at ESG. At the other end of the spectrum, you mentioned the tech companies, which usually are sort of asset light. So if you think about Apple, they don't make any of these iPhones. They are all made in China, outsourced to somebody else. And so in a sense, they outsource all the assets, they outsource all the manufacturing, and so they outsource all the problems to someone else. And so it can be just using screens and scoring from third-party providers in particular. It can be very easy to say all the value companies are poor, have poor practices, and then all the growth companies have high scores. But I think you need to really look beyond that and think, well, maybe Amazon looks great, but because they once again, they don't own much of their assets. I mean, some of their data centers. But if you go beyond that and you think, well, Amazon's business model is all about moving things around and flying things very quickly from one place to the other, and using trucks to move single parcels from the warehouse to your doorstep. And it may be very convenient, but it also has an environmental cost, because flying parcels very fast from one place to the other and moving them in trucks emits a lot of carbon. And so they may outsource all that activity to somebody else, but ultimately it is their business. It is part of what they do and what they sell to you. And so this cost should be allocated, assigned to their business model. And so you really need to go just beyond the own operations of these companies and try and think about their entire value chain, their entire ecosystem, and think what sort of practices they are driving. And so that's really where I believe fundamental investing can add value versus passive type of investing. And that was one of the previous poll. I truly believe that passive investing has a role to play, and some people may be attracted to the low fees, but in the case of ESG, I believe you truly need to go beyond that and try and be active to not only find the right product for you with the right negative screening, the right values, but really to have humans there who can really think about more holistically about the entire ecosystem of a business, and not only about the narrow operation that a company uses, the company operates. And so that's really where humans and fundamental investing can significantly add value versus passive, in my view.
Thanks, Alexis. And let me share the results of our previous poll, because I think all our attendees, they're also sharing, or the majority of our attendees are sharing the view that you just expressed, as we have also 73% of our funds or ETFs are the way to go for them, where they believe that they have the best access to ESG investments. Now, active investments in the fund space, or for an impact fund, Victoria, that brings me to you. One thing that I personally found intriguing to ask you is, or looking forward to ask you, is like, how do you manage that in your day-to-day work? Because I think you also developed your proprietary index or criteria to measure impacts, etc. Can you give us a little bit of perspective how you implement active strategy in investment? Sorry, Victoria, can you hear me?
I'm sorry, I don't know if it's my line that's frozen or yours, but I couldn't hear your question, I'm afraid. Okay,
sorry for that. I hope it's working now. No, I wanted to ask you, one of the questions that I had for you is, we were just talking about this active versus passive investing. And while we do have a preference for active investments from clients as well as from practitioners' side, but in the impact investing space, can you let us know a little bit more of an insight as to how do you go about active management here? And then also, second part of the question would be, is it even possible to have a passive investment in the ESG space or in impact investing?
Got it this time, thank you. I hope everyone can hear me too. Well, to take the last question first, I would say it's very difficult to have passive in impact because there isn't really an index. So that immediately makes that a little bit more complex. And I would argue in secondary markets, you need active investments to really define a listed equity fund as impactful. But I'm probably not the best placed person to answer that question for broader ESG products. But just to cover how we kind of focus our sort of active energy in impact in listed markets. Yes, it's engagement, as I touched on before. That's really important, and also our way of assessing impact. That's something that really doesn't occur in the passive world, in the sense that we've built a bottom-up proprietary system, and we've actually borrowed that largely from the private sector and built on it. And so private equity, private debts in impact investment typically look at the materiality of a company, the materiality of their revenue streams. We look at that too. You know, what proportion of a company's products are generating a positive impact. But actually, that on its own is pretty two-dimensional. We need to look at the direction of travel of any given business as well. And so, again, this is only really possible with a focused, active, well-trained impact team. I'm looking to my left because I can see them all beavering away while I'm talking to you. And so we also look at intentionality, which is forward-looking. And this isn't just about what a company says or a CEO's stated targets. This is about how they're allocating CapEx. What type of acquisitions are they making? You know, what's their R&D profile and the shape of that? These are real indicators of the revenue streams of these businesses in 3 to 5 years' time. And that's what we want to capture. We want to capture businesses that are not just impactful now in their current state, but they are going to continue to be so, and they're committed to going on that journey. And we, in addition to that, look at probably more traditional measures such as additionality and the total addressable market of those businesses to come up with an overall score, which can really, we hope, assess the impact of a business in a way that you can't by running a top-down screen or a quantitative model. You really have to dig deep. It's a very labor-intensive process.
Yeah, that sounds like it's also going to be difficult even for private investors to just replicate something similar. So it speaks again for the argument of having a actively managed fund product, because I can assume that UBP as well as GSAM, I also know it on our side on Kristal, we do spend a lot of resources on that in order to identify these opportunities. Talking about opportunities, and Victoria, maybe I stay with you straight away. One thing that Alexis mentioned in the first part of our discussion was about kind of like the next sectors. One thing that makes me wonder, we have the ESG and the entire sector has evolved a lot over the last couple of years. I'm kind of like, personally, I'm still split in the with regards to the question, what is priced into the market already and what not, in terms of, has the market discounted correctly the fact that doing good means superior returns or not? Is the premium justified that some of these ESG compliant companies are commanding? But leaving that aside, this discussion about pricing or not, which is a little bit of a chicken and eggs debate, are there any specific sectors in that space where you do see opportunity, or what is your overall view at the moment? Where do you see opportunity? Is it more in renewable energy space? We have some people who are saying carbon credit markets are the way to go. So what's your view with regards to that? What are the next opportunities?
Sure. I think there are lots, and I think this is actually linked in part to the increase in disclosure, corporate disclosure, so that it's enabling product designers to provide more specific products for end clients. So to take that another way, I think end asset owners are used to having to make the decision of, ESG impact, sometimes a climate change fund, but nothing really more nuanced than that typically. And I think this the increasing disclosure means that I foresee a situation where there can be dedicated social funds. There are some already, but more of them, and areas such as the circular economy or biodiversity. And circular economy, I think, is a hugely interesting area. We've focused a lot on climate, rightly so, for the last 5 years, but closing the loop of our consumption as a society is an integral part of kind of trying to protect the planet. And the innovation and technology behind that is vast. And as a sector, it's growing at a rapid rate. I mean, just to take listed markets, and a subsector of circular economy, the biopolymers, so bio-based plastics that are fully break down. This sector didn't exist really 3 or 4 years ago, certainly in the listed space, and now it has a cumulative market cap of well over 5 billion. Plant-based diets, same thing. The cumulative market cap of listed plant-based diet companies is now over $18 billion. It was 0 4 years ago. So these are areas, and still I don't think we've scratched the surface. And in broader terms, I think the focus on net zero is hugely important, but I think increasingly it needs to be talked about in lockstep with nature positive. And so companies which are providing solutions for the biodiversity crisis we face as a planet should be incredibly well placed to grow faster and be more profitable and benefit from a supportive regulation demand. So there's a huge amount happening that frankly we are just in the foothills of those thematics, in my view.
Yeah, that's a great point. From moving on from net zero to net positive, I like that that phrase. That's a great point. Alexis, how's about it from your side? Where do you see kind of like pockets of opportunity in that space?
Yeah, and you're right. I want to first answer your first question around overvaluation, or whether good ESG companies or companies with good ESG practices and scoring can have good performance over time. Look, it is our expectation that companies with better practices can add more value and can create more value for their shareholder, for all stakeholders, including their shareholders over the long term. But look, I think it's important to remember that ESG investing is not different from traditional fundamental investing. So the strategies that would simply systematically buy companies with, let's say, high ESG scores from certain third-party providers like MSCI and Sustainalytics and so on, and just build a portfolio simplistically based on scoring from third-party providers to essentially focus on companies with high scores, is unlikely to do well over time, because you always need to consider fundamental factor and financial factors at the same time. You can't just look at one side but not the other. I think these ESG investing and traditional fundamental investing are just one thing. So you always need to think about how great a business is, how great their practices are, but what about the price? Is it a great price or not? So I think it always needs to be kept into context, and you need to make sure that you keep an eye on valuation in the same way as you would do for any type of investing, whether it's for yourself or funds or anything. So ESG is a sort of extension of quality at the end of the day. So it's companies with good ESG practices. In other times we used to call them good quality companies. That's essentially what it includes. And to do that, you need to, as Victoria said, you need to not only look at the past, but you need to look at the future. It's about what these companies are doing, how they are changing. Some of them may have a past that's not the best, that's not the greenest, but they may be on a track to become some of these companies that may change the world with some new technologies. And so I think it's important to think about ESG investing fundamentally, and always think about the future, not the past. Now, in terms of opportunities, look, I do believe that climate change is the biggest threat to the world, and in the long term, and that it creates huge opportunity, because it is truly a revolution that we are just embarking on, and that means all sectors in the economy need to change. They need to adapt. They need to create new ways of doing business, new technologies, to have a greener footprint, if you want, and reduce their carbon emissions as a priority, but it includes everything else around all types of pollution that they may generate. And so it's truly of the scale of the Industrial Revolution. We have to rethink the way we do business, we make products, and we behave as consumers as well. And that will create incredible opportunities in the next few years, really in the next couple of decades at least. And so as an investing opportunity, as a wealth creation opportunity, everything that revolves around clean tech, climate tech, and that really includes lots of companies across many sectors. Don't think about it only as clean energy and renewables. That's one part of the answer, but it's about electric vehicles, it's about smart buildings, it's about smart grids. We need more robust and efficient power grids if we want to be able to accommodate more sources of power and more power needs. It's also about the circular economy, as Victoria mentioned, and finding technologies and finding materials that can be easily recycled or biodegrade over time. It's about collecting and waste management and recycling. It's about sustainable consumption at the end of the day. So it's about the consumers making the right choices, or having the opportunity to make the right choices to buy products which have a greener footprint. And so we are seeing that happening in real time. I'm sure all of you, all of us have changed the way they behave, the types of product they consume, and how they are thinking about consuming in the future. So all these technologies, in my view, are among the most attractive investment for the next decade. And that's really the way the world is going. And to some extent, whether you believe in climate change or not is almost irrelevant, because this is the way the world is going. I mean, hopefully you do believe that it exists, it's man-made, and we can hopefully act on it. But you almost don't need to believe it, because this is simply the way the world is going. The renewable power sources are becoming the cheapest, or are already the cheapest in the world. So it's about economics, it's about value as much as it is about value.
Thanks for that perspective. Yes, I agree with that in many respects. However, fantastic discussion and great points raised, but we are almost running out of time. I just want to take the opportunity to go through a few questions for the promised Q&A session. So we have one question from Alvaro, and maybe James, I can put that question to you. Alvaro has been asking, what is the difference in terms of compliance with the ESG programs for a company when investments are coming from USA, Europe, Asia, and or Japan? So meaning, what is the regional or geographical differences when it comes to ESG investments?
That's a great question, very high in everyone's minds. So how are the different sort of regulatory practices affecting how companies are engaging in different areas, how investors are engaging with their companies in different areas, has been a major topic. So as you pointed out earlier, Thomas, Europe has definitely been the leader on that. And part of that has been around the disclosure regulation that's been put in place under EU taxonomy to really help fund managers and also people who invest in assets understand what are the practices of the various fund managers in terms of what is their focus on sustainability and how green are they, and really defining that, because sometimes it's hard to understand that transparency. Well, let's have metrics, let's establish what that looks like, how will the funds report? And I think Europe has really changed the dialogue to be very much more specific. All fund managers, ourselves included, are sort of scrambling a little bit to get all that in place, because the data doesn't always exist that the regulators would like. So this is a process that will occur over the next several years, but I think it really does uplift the transparency. And I think that's the point. If fund managers are saying that they are focusing on these issues, then what's the data that supports the assertions they're making? And it really helps investors who are and asset allocators make those decisions. So I'd say Europe is in the lead, but what we're seeing is that that everybody is seeing that lead that Europe is taking and trying to adopt that locally. So whether it's in Hong Kong or Singapore, where they're also taking a deeper and more nuanced look about, oh, if you want to call yourself an ESG fund, how do you demonstrate it? And when you're looking to register funds in those markets, how do you what standards are you meeting? What are you saying in the prospectus? What do you say about the investment process? So I'd say there's a very, very much a focus on making sure that if somebody says that they're in this area that of course is very trendy and people are talking about a lot, you're actually doing something. In the US, that's been a little further behind, but I'd say regulators in the US, such as the SEC, are starting to focus on this. And I can tell you that as being a US-based organization, we're getting more inquiries and we are more focused on this because we want to make sure that if something is titled ESG in the title, that we're actually, there's a certain minimum critical standard of sort of what we're doing to meet that assertion. So I think that what's really changing in terms of compliance, regulation, is going to be a positive for the industry so that people are not concerned that there's truth in labeling, so that when you take the product that you buy, just like you do at the supermarket, and you turn it over and you see the nutritional facts, establishing what are those facts that investors should be able to see around the various funds, and what does that actually sort of mean in terms of their allowing them to buy what they want to buy, because they think that's sort of from their values-based perspective, but also because they think that's going to be a positive investment impact over time.
Great. Actually, that last point that you raised is actually a good segue over into the next question that we have from one of our attendees. The person was saying that he or she just checked out some of the ESG ETFs, and the top holding that came up is Nestle. So Nestle doesn't necessarily strike one as a top ESG compliant company. They may use a lot of palm oil in their products in the food segment and so forth. So what is it from a categorization that companies are put into? Like, do you as fund managers often agree with that categorization, or do you think that there's much more education needed for investors as well to understand why is Nestle, for example, top-ranked holding in an ESG ETF? Maybe Victoria or Alexis, whoever wants to go first on this one.
Sure. It's a great spot by that member of the audience, I think, and it comes back to that very sort of simplistic argument I made at the beginning of this conversation, which is there's a difference between the way a company behaves and what it sells. So you don't necessarily associate Nestle and coffee and chocolate with being positive impact, but its ESG credentials are actually pretty good. It has quite good transparency, commitments around its supply chain. It does use palm oil, and it's a vocal. It has vocal commitments around the degree of sustainable palm oil in its value chain. It has commitments around the packaging of its products and the amount of recycled raw material going into those. And so I can't off the top of my head remember its board structure that well, but you know, it's unsurprising to me that Nestle scores well from an ESG perspective. And I guess this is an important point, because sometimes investors, perhaps investing in an ESG ETF, might not realize the underlying types of businesses that are in those products, because they don't necessarily associate them with their own definition of ESG. So I think it is important for investors to do what we would call a ticker check and make sure that they're comfortable with the underlyings before they make that commitment. Particularly actually with European companies, because the third-party data providers that are typically used, MSCI, Sustainalytics, there is a significant bias towards very large cap European businesses. So Nestle, Unilever are going to score well, in part because they have huge and very experienced investor relations teams that know exactly how to answer the questionnaires and know exactly which policies to put in place. So you could, in effect, these systems bias against emerging markets businesses often, and smaller companies who don't have the resource to put the necessary policies in place. So it's just, I guess, a warning. I think Nestle is doing a lot of good things, and personally would be reasonably happy holding it in a portfolio, but check those underlyings before you make your decision.
Great, and Thomas, to add to what Victoria just explained very well. Look, at the end of the day, two points. One, ESG remains subjective, so it's going to be hard to find the perfect pool vehicle, the perfect mutual fund where you agree with every single holding, because it is subjective. It is not black and white, and what may work with someone may not work with somebody else. So yes, at the end of the day, you are reliant on the fund manager, or if you're going passive, with an index provider and their methodology as to which stock they are going to pick and how they are going to be thinking about the ESG. Otherwise, ultimately, you can do it yourself and invest in individual stocks, but it becomes very complicated to have the right level of understanding to be able to do that. So keep in mind, it is subjective. It will always remain subjective. So that's the first point. The second point is, as we mentioned earlier, and as Victoria also mentioned, it is about the future, not only about the past. We certainly look at the historical track record, the practices in the past of companies. It is obviously a good indication of the culture and what sort of companies they are, but also our engagement or work with the management teams. And the reason we have dialogue with them is to understand what they are doing, how they are changing their business, and don't necessarily use today's lens to judge actions from 10, 20, 30 years ago, because the issues, the regulations may have been very different back then, and what used to be acceptable back then may not be acceptable today or in the future. So it's always about looking forward and trying to engage with these management teams to understand what they are planning to do and how they are changing their business models, their practices, and adapting to the new world, what their consumers want, what regulation, the way regulation is changing, and so on and so forth. So it is subjective and it is forward-looking.
Great, fantastic points. I can't think of anything better, any better points to end this wonderful session as we are running out of time. I agree with you as well that ESG, it's about some very important subjects, and it gets very emotional for a lot of people. One other thing that I wanted to add a little bit of a perspective from Kristal's side is I looked a little bit into the data of our client groups, and I can also see that with changing demographics, that is also driving ESG acceptance investments. So in our client group between 25 to 40 years, there's a much higher percentage of ESG focusing the portfolios than in those with 40 and plus age groups. So I think as we go along, it's just will become more and more. I do agree with that as well, and definitely exciting times ahead of us. So having said that, I wanted to thank all of my wonderful guests today. Victoria, James, and Alexis, thank you so much. I know you have a very busy schedule. Really glad that you could take out some time for today. It was fantastic, and appreciate your insights. Also to all our attendees, thanks very much for joining us today. If you have any questions about products available on the Kristal platform, please reach out to a licensed advisor. And looking forward to hear from you in the future. Many thanks for joining, and wish you a happy day, and good luck. Thank you. Bye-bye.